We want you to plan for success. Welcome to Planning Matters Radio.
Peter, good to see you. This topic is for everyone. We all need to stop using the S&P 500 as a benchmark. When we hear these headlines about the markets, it's often how the S&P 500 is doing. And of course, the S&P has been on a rally lately, which is why some of us look at our portfolio and then wonder why it's not going up at the same rate. So why don't I invest in what's doing well right now?
Well, the goal is that hopefully we are invested in what's doing well right now, but also have some additional exposure and holdings to other asset classes, and that we are non-correlated and rebalancing appropriately to capture gains in the asset class that is doing well and reinvest those dollars into maybe the asset class that during this particular cycle is underperforming relatively. But that's the true goal of diversification, and the reason why we may want to reconsider just using the S&P or the Dow or the NASDAQ. Like, these are the most widely known and advertised kind of indicators of market health, but the S&P is 500 different companies that are in different sectors of the economy, and certain sectors like this year or presently the tech sector is doing phenomenally well, but there can be subsectors of the market or asset classes within the S&P that are actually down over the same period of time. And the reason why we may not always want to gauge our performance versus a broad index such as the S&P is that the S&P could be up significantly this year, but it was down significantly last year. And we look at our portfolio just over the relative time of this year and say, well, we haven't gained as much as the S&P, but did we lose as much as the S&P last year? We've got to look at this in the context of the total time and our results in both good and bad markets, because maybe we don't have the risk tolerance to invest in the volatility that is represented by a broad index such as the S&P.
Right. We're going to come back to that. But first, I want to ask, because we all know diversification is, of course, very important when it comes to long-term financial success. But market history has proved that a well-diversified portfolio will almost certainly underperform broad markets and most individual asset classes in the short term. So when we look at something like those tech stocks that you mentioned making huge gains, what should we be keeping in mind?
Well, and that depends on what the short term is. If you're talking about a short term period of time where markets are skyrocketing, then yes, maybe a broadly diversified portfolio does underperform. But again, if we take a wider look back up a little bit and see both good periods and bad periods, underperforming is not always a bad thing. If I underperform in a down market, then that may be a good thing, that I've preserved more of the value. And yeah, this quote by Mr. Bryan here, diversification means always having to say you're sorry. I'm not sure I completely agree with that totally, but what he's indicating there is that more and more over the last 25 years or so is that we have seen more correlation between the asset classes, meaning that they are moving in the same direction at the same time. What we want in a portfolio is asset classes that are not correlated. And Wall Street's model of diversification really keeps assets in the same location, all in stocks, bonds, or mutual funds that are generally concentrated within the same group of companies very often. What we truly want for asset diversification is a couple different locations for your money and things that don't move in tandem in the same place at the same time. So underperformance is relative. Again, we also have to look at our individual risk tolerance very carefully to gauge overperformance or underperformance, Erin.
Right, because when we see the markets going up, even though we all want to see huge gains in our portfolios, those big swings may not be in line with our risk tolerance. Explain that, please.
Yeah, so let's stick with the example here of the S&P. The S&P has a pretty high risk exposure. In other words, if I was to invest in just an S&P index fund, I am probably on the upper end of moderately aggressive to aggressive. And many of us have been told that our goal for investing should be to outperform the markets. Well, that's almost a speculative approach and not really reflective of a lot of individuals' risk tolerance, because if we aim to outperform the market when it's going up, then we will also likely outperform the market when it's moving down. In other words, lose more than the market. And not a lot of investors can truly stomach that kind of roller coaster ride. So if we are, let's give the example of a moderate investor, or we have a moderate risk tolerance, maybe that means that we are aimed to capture 40 to 60% of the movement of the market or an index like an S&P. And that's because we aren't comfortable losing as much as the S&P might lose. Now, in good times, we try to be toward the upper end of that range, more toward capturing the 60%. During bad times, hopefully we can be toward the lower end of that range and only capture maybe the less end of the spectrum of downturns in the market. But most people's risk tolerance that I talk to, unless they are young and have many, many years and decades in front of them of continued income earning potential years to weather these storms and market volatility, they really aren't as comfortable with the risk exposure as what an approach to beat the returns of the market would indicate.
Mm-hmm. It all comes back to behavioral finance, right? I'm a smart guy. Why do I make these irrational financial decisions?
Emotion, fear, and greed. It is what drives our decisions, especially our financial decisions. In fact, I've read and heard stats that say affluent guys are actually ones that are more susceptible to financial fraud because of the emotion of greed. They don't want to miss out on the opportunity for that home run, but all of us are subject to it. And when the market's going well, we have a general sense of euphoria and FOMO, fear of missing out. And so we get a little greedy and buy in. And when the market's not going so well, when we're seeing challenging economy and bear market, we get fearful and we again make an emotional reaction and sell out. And there's an old joke that we repeat the process until broke on that chart that you're showing there. There's another joke in the market. How do you make $1 million? Well, you start with 2, and it's because of exactly this chart and those emotional reactions. So if you have a good plan in place, if you have a truly diversified portfolio with non-correlated assets, those are going to give you guidelines to hopefully avoid some of those knee-jerk emotional reaction decisions.
Mm-hmm. But it all comes back to having that plan. So Peter, if somebody wants to talk to you about the headlines or how their portfolio is moving or their risk tolerance, what's the best way to get a hold of you?
Yeah, just give us a call at Richon Planning, 919-300-5886, 919-300-5886. The investment analysis is part of our optimized retirement plan. We do go through a risk profile, trying to get a good handle on your individual risk tolerance. And then we analyze the positions in the portfolio to make sure that the risk exposure that you have matches up with that risk tolerance, or you're aware if not. That is part of the plan. We also look at income, taxes, healthcare, legacy, and bring that all together. And if you would like to get that complimentary review and that optimized retirement plan, including the investment analysis, pick up the phone, give us a call, 919-300-5886, or you can go online, richonplanning.com. It looks like richonplanning.com, or email me, Peter at richonplanning.com.
All right, Peter, thank you.
Absolutely, Erin. Thank you.
This has been Planning Matters Radio.
The content of this radio show is provided for informational purposes only and is not a solicitation or recommendation of any investment strategy. You are encouraged to seek investment, tax, or legal advice from an independent professional advisor. Any investments and/or investment strategies mentioned involve risk, including the possible loss of principal. Advisory services offered through Brookzone Capital Management, a registered investment advisor.
Fiduciary duty extends solely to investment advisory advice and does not extend to other activities such as insurance or broker-dealer services. Advisory clients are charged a quarterly fee for assets under management, while insurance products pay a commission, which may result in a conflict of interest regarding compensation.